Good morning. It is Monday, June 16th, 2025. I am Herb Morgan, Senior Managing Director and Chief Investment Officer for Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary for the week beginning today. As always, you can follow me intra-week if you want on LinkedIn, Herb Morgan, or on X at Herb W. Morgan, where if there's some developments or I have something to say, you'll be sure to get it there first. The presentation you are seeing and are hearing is developed by me. It is designed to be used by you. It doesn't matter if you are an investor or a financial advisor, but either way, you must make your own investment decisions. Nothing contained in this presentation is investment, tax, advice, no recommendation for the purchase or sale of securities. It's strictly informational. The views are mine and mine alone and may differ from the views of CFIA's parent affiliates or other portfolio managers. Well, we had a mostly down week, as you can see, plenty of red on the screen. The exception there being emerging markets, which had a nice run last week, and emerging is now really joined with developed international markets to be leading the way. S&P 500 still hanging on to gains for the year, getting close into those all-time highs. But mid and small cap stocks really took a beating last week and are down significantly on a year-to-date basis. Interest rates came down a little last week. You can see the ag was up about 0.2%, and the longer-term Treasury index about 1.08%. Yields on the 10-year Treasury still hovering around 4.4. Let's get into economic data, what I think it means. You know, we've got a Fed meeting on tap this week. That's very, very important. We did get a surprise beat, a beat of the estimate for small business optimism. National Federation of Independent Businesses came in at 98.8. That was well above the 96 estimate, and it reverses several down months. Still high levels of uncertainty around tariffs, what the tax legislation is, what ultimately becomes of the one big beautiful bill. Economic outlook, however, improved, as did the outlook for sales. Probably the most uplifting data for the week was the CPI. May CPI was up 0.1%. That's very doable if we have that every month. The estimate was 0.2. The year over year, though, still above the Fed's target of 2, came in at 2.4. Core CPI, though, this is where we really got good news, 0.1. The estimate was 0.3. That's a third of what was estimated. And the year over year now solidly below 3, I guess, 2.8 versus an estimate of 2.9. So we've got a Fed meeting this week. The reason the Fed can't or won't lower rates is because inflation is still above the core PCE target of 2%. This is CPI, different but similar. So the Fed really can't cut rates, but we're starting to see some softness in the labor market. And remember, the Fed has a dual mandate. So we're going to look at the labor data here shortly. But before we do, let's stick with inflation data and say, when will this number start getting closer to the 2% target so that the Fed is in the clear to start cutting rates? So let's look at the monthly core CPI readings, okay, core being the red line from the previous graph. As you can see right here, June of 24 is about to roll off next month. So we're not going to get an improvement in the year over year if we get another 0.1 or even a 0.2, and what rolls off is a 0.1. We're probably not going to get much improvement in July either, but look at what happens when we get to August, September, October, and November, December, January. The remainder of the year, my guess is everything that rolls off is likely to be replaced with a much better number, therefore making the 1 year, the year over year number, much better, and we're going to start seeing it decline. This is why when you look at Fed funds futures, they're not expecting a rate cut this week for the June meeting, but they are expecting rate cuts as we go further out into the summer and into the fall. They're seeing the data we're seeing, and it makes sense that the futures markets are making that prediction. In addition to CPI last week, we got PPI, also up 0.1%, also beating expectations, 2.6 year over year. Core also 0.1 versus a 0.3 estimate, just like the CPI, and still though, however, stubbornly above that too. Same kind of thing there. June is not going to be a rough number that falls off and helps. Neither is July really, but when you start getting into August through the end of the year, the number that falls off is likely to be replaced by a lower number, making that year-over-year number palatable and enabling the Fed to be able to give us those rate cuts. Here's the bad news on the week. Weekly jobless claims are still elevated. Now, they were unchanged from the prior week, and don't get me wrong, 248,000 is not elevated on an absolute level. It's elevated compared to where we were in this sort of low 200, like 220 level, right? This is kind of where we've been, and it does appear that we are coming out of that and trending higher. And believe me, the Fed has got their eyes on that. What the Fed doesn't want to see, what nobody wants to see, is stagflation. That is jobless claims going up, demand coming down, and inflation not coming down with it. Because then the Fed's in a bind. Which mandate is superior? Which mandate do you follow? Do you cut rates in order to spur job creation, but you also spur inflation with it? So it's a very, very precarious situation and tightrope that the Fed has to navigate. Next, we got Michigan sentiment for the month of June. Surprise, surprise, big jump from 52.2 to 60.5 and way above estimates. But that is still a low number compared to where we were, let's just say, prior to 2020 and COVID. We are still kind of near the lower range of the last 5 years. Now, the stock market has come back from the sell-off, and that has made stocks, well, somewhat expensive. Looking at Friday, we have the risk-free earnings yield of the S&P 500. That's the inverse of the PE ratio. It's the E to P ratio, just upside down, 4.4%. Risk-free, 4.4%. If inflation really is coming down to 2, is not bad. That's a real return of 2.4. And then you compare that to the earnings yield of stocks at about 3.9%, you're actually getting paid more to not take risk. But of course, there's uncertainty in stocks. So either the market's overvalued, the bond market's undervalued, or the market is entirely efficient and the stock market is telling us that earnings are going to be far better than we expect. None of those are unrealistic interpretations of what we're seeing here. We are in a secular change and a secular movement related to the adoption of AI that is driving massive efficiencies. And that's a good thing. We're also in the middle of a change, which I've talked to you about over and over in this podcast, and that is a change from this reliance on a government-run economy, on a stimulus, fiscal stimulus run, deficit finance fiscal stimulus, or monetary stimulus-based economy. And the current approach to economic growth is to encourage direct CapEx, capital investment in the United States from either foreign or domestic sources. And there's a big emphasis on getting that foreign direct investment into the U.S. Now, I've showed you this chart a couple of times, and I just updated it again this week. These are the announced investments. So some have happened, some have partially happened, some are scheduled to happen over many years. I imagine even some could be reversed. I know a lot of people are suspicious of announcements and would rather wait to see till the actual investment takes place. But in light of the performance of the equity markets, this is a reasonable, at least partial explanation of what's happening. This is a very significant amount, right? $2 trillion in private sector investment is probably the economic GDP equivalent of $3.5, $4, $5 trillion of government stimulus, so Keynesian-style stimulus spending. Why? Because the multiplier effect of private investment is far greater than the multiplier effect, meaning how many times it circulates through the economy, than is the government stimulus. So we were approaching $2 trillion, and then, of course, over the weekend we heard the announcement that the president approved the Nippon Steel investment in U.S. Steel, and as part of the negotiations that they made, that Nippon Steel would promise to invest $11 billion into the U.S., and that put them over the $2 trillion mark. Includes some national security things that the administration wanted to have in there. And it leads us to ask, well, a lot of people have been very skeptical of the administration's economic plans, particularly around a manufacturing renaissance. And with $2 trillion in announced deals, barely a few months into this, none of course, has happened yet. We know that. But with the announcement of these deals, if even half don't materialize, it's a very, very significant boost to economic output and GDP. And perhaps that is at least partially to blame for and discounted into the price of equities that we see as they've been rising here since the sell-off related to the tariff tantrum. Okay, economic data this week. New York State Manufacturing Index expected negative again. We've got retail sales, import and export prices, industrial production capacity utilization, 77.7, fine. Business inventories and housing starts, building permits, weekly claims are getting more important. They've been really boring for a couple of years. We want to keep an eye on those. Weekly claims at 245. And then, of course, the Fed's rate decision. The Fed will meet Tuesday and Wednesday. We will, I do not believe, get a rate decision at all on Wednesday. I think nobody believes that. But instead, maybe some guidance for the future. Nothing Thursday. And then Philly Fed, which comes after the New York. New York is today, Monday. Philly Fed will be on Friday. We're looking for a negative number there. Thanks for listening or watching. If you're watching, of course, it's on the YouTube. If you're listening, you're getting half the fun. You have to get on the YouTube and see the charts and graphs. Much better there. You can download them from our website as well, print. If you got any questions, you want to discuss a topic, you want me to include a topic next week, just email herb.morgan@cantor.com. Email me and I'll make sure to get it on there. herb.morgan@cantor, CANTOR.com. Thanks everybody for tuning in. I'll be back to you again next week.